Banks don't care about you. The government doesn't care about you. So obviously you need to take control. Getting out of debt equals essentially freedom. We discuss taking control of your finances, getting out of debt, and your future. Every Friday, we look at dollar alternatives. Now, first, let me tell you, this is not financial advice. I'm not a financial advisor. Now, why do we look at dollar alternatives? Because if you're saving money in a savings account for emergency funds, for whatever it may be, down payment on a house or buying a car, as we know, because of inflation and other factors, the dollar is losing value. We're going to discuss some of that today. And then we're going to look at the alternatives to holding just dollars. What can you do to maintain some of that purchasing power? In a moment, I'm going to give you a visual representation of that, and also a very interesting video by a popular individual, Cathie of ARK Investments. But first, take a look at this government spending. Here by Bloomberg, recently it said 1 million simulations shows U.S. debt danger. And I'll explain why this relates to you saving alternatives to the dollar. There's a bit of a boy who cried wolf problem with warnings about U.S. debt sustainability. What do they mean? It means that every year we talk about the U.S. has too much debt, it has too much debt, it has too much debt, but nothing seems to implode and we just keep moving along. But it does cause problems. So they say concerns have abounded for years. However, low interest rates have helped keep things under wraps. Low interest rates are no longer low. The Federal Reserve has raised rates. Even though they're still reasonable, they did raise rates. And they said there were various alternative scenarios that always seemed possible. In other words, even though the federal government's debt keeps going up and up and up, it seemed like it was under control or being managed, some people think. They said inflation will help eat away the debt burden. Productivity will accelerate, productivity being the GDP of the nation becoming more productive. Tax cuts, not sure where those were, will boost growth, and Treasury revenues will soar. Okay, that's what was thought to be happening. But they've got analysis from Bloomberg Economics, and it says they ran a bunch of different scenarios. They looked at combinations of economic variables, 1 million combinations, and 88% of the time, the results showed that the debt to GDP ratio is on an unsustainable path. Think of it this way. Think of GDP as the money you're bringing in personally, and debt being your debt. So you look at how much is coming in and how much is going out. We've got more going out than we have coming in. That's a problem. How long can that continue? How long can the government continue to run deficits and run up the debt? Well, in the past, with low interest rates and other things, it looked like it was manageable. But what they're showing is that it's not 88% of the time. From 2024 moving forward, and as you can see, as it goes up and to the right, it's getting worse and worse and worse, meaning where you have more debt than we have output, or let's say income. BlackRock CEO Larry Fink said last week the U.S. public debt situation is more urgent than he can ever remember. Take a look at this. The federal government, I've just got two more of these. This is federal government current expenditures, interest payments only. If you look back here around 2000, $300 billion in interest being paid by the government. And this is as of December of last year, 2023. They were up to over $1 trillion in only interest payments. Look at this trajectory, almost straight up. That's why they're talking about it being unsustainable. And that's why it's damaging the dollar, because it's devaluing our currency. Look at this quote. We've got the Fed chairman here. It says, America will be left with severe, irreversible scars if national debt goes unchecked. A blockbuster report warns the bill is higher than believed, hitting $141 trillion by 2054. If they continue on the path they're on, and they keep spending more money than they have and running up debt, it's going to cause a problem. Now look at this visual representation, which I think is interesting. And the reason I do these Friday updates on a basket of alternatives to the dollar. This is a report, and they show it graphically, from 1970 to 2023. Here's 1970, and it goes to 2023. And the assumption is if you started with $100, what did you do with it? Well, $100 after this span of time, after 53 years, would be worth $956 in cash. By the way, they say here that cash is represented by 3-month treasury bills, which is a higher interest rate typically than what you're going to get in a bank savings account. So this is even more than you would have gotten just sitting in a savings account. But let's just assume that this is correct. It's about $1,000. They say over that period of time, you would have made $1,500 in real estate, 5.5% average annual over that period. Of course, that's over a long period of time. We had the GFC of 2008 when real estate came down. So even though it's been high recently, this is over a long average over a long period of time. They said, all right, what if you put it in 10-year treasury bonds? You'd have a little over $2,000. What if you bought gold with it? Well, that's substantially different. Instead of $1,000, you would have had $5,500. T-bills, bonds, gold, these are things we talk about being alternatives, which we'll get to. Corporate bonds, which I find is interesting, they're a particular type of bonds. So T-bills, treasury bonds, being buying essentially the debt of the government as opposed to the debt of corporations. And then up here, S&P 500, if you put it into an S&P 500 index fund, it would be worth $22,000. Tony Robbins recently did a book that I read, I don't know how recent it was, about how if you didn't want to think about anything and you wanted to invest some money, you would just shove it in the S&P 500 and let it sit because over time it does very well. Now, we're not talking in these videos about investing your money. We're just talking about the portion of money that you use as savings for expenses that may come up, emergency expenses, new air conditioning unit, new car, whatever you may want to put it down for. Not all your investment, just what can you do to keep those dollars and keep the value of the dollars. All right, now watch this video by Cathie Woods. This is fascinating.
What's your analysis of why it's moved the way it has?
Okay, up dramatically.
Right.
You have the ETFs. There's something else going on around the world. There are currency devaluations taking place that people are not talking about. The Nigerian naira is down 50-60% in the last 9 months. Egypt just devalued by 40%. Argentina continuing to devalue. I think this is a flight to safety, believe it or not, taking place. A hedge against devaluation, a hedge against a loss of purchasing power and wealth. That's very important. And we saw this even here last year in the United States. Regional banks imploded. Bitcoin went up 40%. Bitcoin does not have counterparty risk. I think, and we're putting out a piece in the next few weeks, which is, this is both, get this, a risk on asset. And so you talk about the NASDAQ.
The risk on.
But it is risk off. I remember we got in at $250 when Greece was threatening to leave the euro, right?
But is that folks that are speculating about currency, or is that folks in Nigeria and in Greece and other places saying, I got to get my money out of this currency and move it themselves? Do you see what I'm saying?
Oh, yes. I think this is an insurance policy against rogue regimes or against just horrible fiscal and monetary policy.
So you can see from that video that she's also describing the case of the currency losing value, other countries' currency as well as the US. And she's talking about, in particular, she happens to be talking about Bitcoin as being a hedge against inflation. In other words, instead of holding dollars in your account, you hold some Bitcoin. So we talk about, and I show the updates from when we first started this, taking a portion of your money and putting it into alternatives. So you might have some in a checking account or a savings account with an interest rate. You might rotate some with a CD. You might rotate some with a 3-month treasury to get a higher rate. But to really beat inflation, we look at things like here. Gold is now up $2,338. It's hitting an all-time high, I believe, or at least a recent high. Silver's at $27.57. Bitcoin at $68,252 and Ethereum at $3,325. So let's talk about these. So when it comes to things like gold and silver, yes, you can go out and physically buy these, but then selling them can be a little more difficult. You want to keep things more liquid. You can simply buy a gold fund or a gold ETF. I happen to like a little mix of the two, a hybrid method where I use a company called Vaulted. I've got videos on that where I send money in periodically and it purchases gold and silver on my behalf and holds it for me. What I like about that is it's much easier for me to sell. There are transaction fees, but I can essentially just go on, click and sell, as opposed to having to take my gold bar down to the store and try to sell it. Then when it comes to cryptocurrencies, I believe there's might be 9,500 different currencies. But when it comes to the most talked about, that's Bitcoin, which is completely different than all the rest. But Bitcoin and Ethereum are usually talked about in the same breath because they're essentially like that first mover, if you will. Bitcoin being the world's gold, as some say, and Ethereum being the world's computer. Of course, there's many others coming up. But just to give you an idea, as part of our basket, it's some cash, CDs and treasuries rotating, but then gold and silver and cryptocurrency. That's what I do, not suggesting you do it, in order to try to beat the rate of essentially, and because of inflation, the rate that the dollar decreases. And as you can see from that chart that we showed earlier, if just sitting in cash, we're saying, no, spread it out into other things like treasuries, bonds, gold. And what this chart doesn't show is Bitcoin. We don't suggest this S&P 500 because this is just diversifying that emergency savings or portion of cash of your entire overall. So if you've got stocks and real estate and retirement funds and all these different things, and then you've got a section of cash, instead of just having cash, you can break it up into this basket of goods that we look at every week. I'll mention a couple things that aren't updated is because we look at monthly when it comes out from the government, the average rates of savings as well as CDs and treasuries. Sometimes they are not beating inflation. So if they're not, then that dollar is still losing value, just not as much. Sometimes they are. But as you can see from the past, these alternatives like gold and silver and Bitcoin and crypto is outpacing inflation. Lastly, we look at the 10-year treasury note because this is looked as a barometer to what the market thinks is happening overall, and things such as mortgage rates they're not directly tied, but they tend to have a pretty close correlation. So when the treasury 10-year goes up, mortgage rates tend to go up. When they go down, they tend to go down. It's sitting here at 4.375 today. So I hope this has been helpful. Every week we talk about getting out of debt and the state of the economy. And every Friday we talk about this basket of alternatives if you want to try to beat inflation so you don't keep losing purchasing power. Thanks for watching. I hope this has been helpful.